Yeah, good morning. Happy Wednesday. Just glancing at the day there, checking I'm up to speed. This last couple of days has flown by. Welcome to another AdviseWise webinar. And today I'm joined by Gemma Brown. Gemma Brown is the Southwest and Wales BDM at Pure Retirement, and she's going to be talking us through today all things interest servicing. You've probably noticed and seen quite a lot of these style of products coming out of the woodwork over the last year to 18 months. There's some great features in there to help enhance and save money for your customers. And we're going to be going through the intricacies of the Pure Retirement Heritage Interest Service Mortgage. But before I do, I just wanted to go through a couple of housekeeping bits, a couple of items just to keep the session running nice and smoothly. So just a reminder that if we can keep microphones muted throughout the session, it just helps with the viewing experience for everybody else. You're more than welcome to undo your camera. Don't be shy, but it might help yourself from a viewing perspective if you've got terrible internet at home. We want to encourage engagement and questions as much as possible. And you probably have found the chat box at the bottom of your screen already on these live sessions. I have just chucked a couple of links in, so you should see a little notifications box at the bottom with a couple of links in there. If we can use that for questions where possible throughout the session, we will also have an opportunity to ask questions at the end with a bit of a Q&A, an opportunity to unmute your microphones and ask Gemma and myself some questions there too. But keep an eye on the chat because hopefully you'll be able to see other people's questions. You'll be able to see some of the content links and signposts we put in there too. This session is being recorded. It is going to be viewable after the session, and we will, AdviseWise will follow up with an email roundup so that you can watch it back retrospectively, you can share it with your peers, and you can capture that all-important CPD. So no need to chase us and ask when you'll be able to get the CPD request button. That will all come as a follow-up email to you as well. I will get you passed on to Gemma in just a brief second, but I just wanted to mention from AdviseWise's perspective, I see lots of familiar names in the chat, but some of them are maybe not so familiar. If you haven't already booked a demo, there's been loads of new improvements added to the platform over the last couple of months, and we've got quite a few bits to add over the next couple of months as well when it comes to improving the sourcing journey, making it more intuitive and making it more efficient ultimately for you, the advisor. So if you'd like to know how to leverage AdviseWise and the tech a little bit more, you're more than welcome to book a demo with myself or the team. I am going to loosely touch on our brand new cost calculator at the end of this session. Some of you might not have seen that. It's a little button at the bottom of your sourcing window. So if you want to dive into a bit more detail on that, you're more than welcome to pick that up with myself and the team at some point over the next few weeks. Couple of stats to get you going, get the thought juices flowing this morning, just in and around the later life market at the moment. Okay, so I know it might not feel like it. The last year, 18 months has been incredibly difficult. We're certainly not in a 2022 market in the moment when it comes to lending volumes and value, but the over 55 population is expected to grow by 20% over the next 10 years. People are living longer. They require greater financial flexibility during retirement. People are retiring asset rich and cash poor, and I'm sure you're dealing with those types of consumers on a daily and a weekly basis. So it's important that we keep educating and we keep promoting these types of products within the sector. Equity release annual lending. In 2023, we obviously saw a 2.6 billion market, but that wasn't a shadow on the year before, which was a record-breaking 6.2 billion in 2022. But hopefully some of these figures thrown out there just show you the opportunity that later life lending has to offer. I know it's not a fraction on the traditional mortgage market, and we, the collective we, have a massive job to do in educating and signposting that market and proposition. Pension shortfall, approximately 1 in 3 retirees in the UK are at risk of experiencing a pension income gap. It just highlights the importance of accessing things like home equity as an option to help them into retirement planning. Some of you might have seen the bulletin from the FCA earlier this week, and as part of their 2-year priorities, the provision of retirement income and retirement planning is high on the agenda, and we all need to work together to do that. When it comes to later life lending solutions, I personally have family members, and I've recommended family members to talk to advisors and engage with this product set. I can see from across the sector the hard work and innovation that our lenders are bringing to the table, and I can see the hard work and the amazing work that advisors and industry professionals are doing to continually fly the flag and market these types of solutions. So please keep doing that. It's definitely going to be a collective effort to help this sector recover and grow in years to come. Now over to Gemma for the bulk of today's session. Again, we're going to be going through the new Heritage Intra-Service Lifetime Mortgage. There's lots of acronyms in this sector when it comes to LTM. We've got RIO, we've got TIO, we've got ISM, we've got PTLM, and it can be quite confusing. So hopefully we'll be able to leave this session with a really good understanding of the core features and benefits and things to be aware of, the discounts available, and how you can bring that flexibility to your clients. So Gemma, over to you to take the stage.
Great, thank you, Dan. Good morning, everyone. So I can see a few familiar names here, but obviously, as Daniel said, I'm Gemma Brown, South West and Wales BDM for Pure. So thank you for giving us your time today just to talk about our very exciting new heritage feature. So I am going to share my screen. Okay, so we've launched interest servicing on our heritage range. So it's the heritage product with an added feature of interest servicing as an option. So an interest service lifetime mortgage, it offers customers an interest rate discount. So if they decide they want to make monthly payments on their lifetime mortgage, they can do that, and they have an option to stop making the payments at any time. So it's not mandatory payments. Key features for our product. So we have interest rates that are discounted up to 1%. So I'll show you the discounts a little bit later in the slides. But the highest discount they can apply is 1%. It's product led as well. So the discount applies per product, not how much they actually wish to service. Customers can make monthly payments of at least 25% of the monthly interest. So as long as they're doing 25%, they qualify for a discount. So it's 25% to 100% of interest servicing that they can do on the product. They can apply for drawdown in addition. So we could take an initial lump sum, which they can interest serve, and then they can take further drawdown later on. So they can still have the features of heritage in that way. If they do choose to take drawdown at a later date, they have an option then to service that interest. So they don't have to service interest on any further borrowing that they do, but they can do if they want to. A really flexible feature of this as well is they can take 3 months payment holiday in every 12-month period. And I'll touch on that a bit in a later slide. And obviously, it really can reduce the client's cost of borrowing. And I've got some good examples of that to show you as well. And with all of our products, this does meet the Equity Release Council's core standards. On all of the products that we have with interest servicing, there are no arrangement fees. So I know other providers do have arrangement fees on their interest serviced options. We don't. There are no arrangement fees associated. As I've already mentioned, it's applicable to a lump sum and further drawdown. Our heritage product does have cashback as well, so you can still apply for the cashback with heritage on the interest services as you can already. Clients will still have visibility of MyPure, which is our online platform where clients can access their mortgage. They can have a look at their balance. They can have a look at their interest, how it's rolling up, how their interest payments are actually making a difference. They can download annual statements. So they've still got the flexibility of using that there as well. One really important feature or element to mention is they can't do ERC-free partial repayments whilst they're servicing interest. So if they are servicing interest on the mortgage, they can do that, but they won't be able to make further ERC payments. They can overpay it, but it would be subject to ERC. Once they switch the interest servicing off, they can then overpay it, and it would just turn into a standard heritage product with the overpayment facility available. So as mentioned, we will do up to 1% MER on each plan. So it's product led. Really important as well, after the mortgage has been set up, the monthly amount specified at the beginning can't be changed. So say, for example, they choose that they want to service 25%, they can't then decide in a few months' time to service 75%. It has to be set out at the outset, and vice versa. If they decide they want to service 100, they can't reduce that. It has to be the amount set at that time, which they cannot change. The exact discount offered is dependent on the plan, and I'll show you that in a second as well. And obviously it's sourcing, which it's available on all sourcing platforms, but Dan's going to show you advice-wise a little bit later. I've got a bit of a delay there, but never mind. So here are our discounts. So as you can see, Heritage Super is 0.3%, right up to Heritage Special 3, which is a whole % discount. So as I mentioned before, clients can service 25% of the interest or 75% of the interest, and they get the same discount. Their discount isn't led by servicing more. They can also service it for as long as they want to as well. So they don't have to specify a time up front. So they say, for example, they take out Heritage Supermax Plus at 0.4% discount. They can service that for 2 years, 5 years, the whole lifetime of the plan, and they'll still qualify for that same discount. At any point, they can switch it off and they just lose that discount, and it would revert to the rate that it was on originally. Same with all those products as well. We've got a couple of examples here of how it actually works in practice, and this might be quite a good one to screenshot. So this is an example of a property value of 275,000 with a 1% discount, so it'd be on the Heritage Special 3. The client here is releasing £60,000. So as you can see on the top bar there, there's no discount applied, so it's a standard rate, no interest service payment, so there's no saving to be made there. It's just a standard roll-up mortgage. If they make 25% payments, which with 1% discount, which works out to £87 per month, they will, and they pay that for 5 years. The savings over the interest period can be up to about 18,000, well, over £18,000, which is huge, even on 25%. Example there of 10 years, again, same payment they've been making for the 10-year period, savings of up to 30,000, and again, 15 years. So if they service 25% of the interest for 15 years, they're almost saving £40,000 on that loan. Same again, but with 100%. So it highlights the difference that even whatever interest service payment that they make, it does have a massive impact on their overall cost of borrowing. So again, same situation here, same scenario. So we've got a £270,000 property with a 1% discount, £60,000, but this time they're paying 100%. So they're paying 100% of the interest, which works out at £349 per month. So again, we've got here the 5-year payments, £44,000 discount savings, up to 15 years where they can make up to £75,000 savings. So it's huge, the discount that can have, the difference that can have. And again, it's important to know it's not specified that they have to do increments. They can, as long as they're servicing interest between 25 to 100%, that's absolutely fine. With the calculators and things that we've got online, it does help you where you can put in monetary amounts or percentage amounts. And I know Dan's going to show you that as well with the AdviceWise platform. But as long as they're servicing within those amounts, they get the discount appropriate to that product. We aren't going to stress test this, so it's not stress tested. We don't do affordability calculations, but advisors should carry out the suitable assessment of affordability in the background once you're doing your fact finds and things like that. So it's really important with this, as I mentioned before, because they can't change the amount. Once the amount's been set up, it can't change. So obviously you're looking at the bank statements, their situation, how long they might want to pay for, that kind of thing. But once it's been set up, it can't change. It's set up on a direct debit as well. So you'll set the direct debit up on application. The direct debit will come out on the 1st of the month, I believe, and stay at that amount for the duration of the mortgage. At any point, they can switch it off and decide not to pay that anymore. And if they do that, obviously, as we said, it goes on to they lose the discount, basically. I mentioned payment holidays before. So payment holidays it's a really good flexible feature within our product here. So clients can take 3 months every 12-month period of a payment holiday. So in effect, they only have to pay their interest service payments for 9 months to qualify for this. If they then miss an extra one, so if it goes to 4, they will lose the discount and it will switch on to a switch back off basically, and go on to a roll up. When they're missing the payments, they don't have to then make them up. So it's not a case of I've missed one this month, I need to now pay £200 next month. You don't have to do that. That payment that they've missed will just add on to the roll up. If they want to, they can do that. So if they did miss one, but they didn't mean to for any reason, or they've actually decided we want to make that payment, they can do that as long as they call us and make that payment before the next one is due. They can let us know in advance of their payment holidays if they know, it's Christmas, we've got big plans for our grandchildren's Christmas presents, a bit of a planned example, they can do that. If not, they can miss them and we'll write to them, it'll trigger in our system. I believe other providers, they can only do 3 months payments within the whole period. So this just does give a little bit more flexibility to clients, knowing that they're not going to lose that discount if they do have a couple of months, as we said, Christmas time, or they want to take everybody on holiday to Disneyland. They can do that with this without the need to top it up afterwards. This is a really good example, and again, a good one to possibly screenshot to share with clients. So this is an example of, so it's the highest discount available. So it's the Heritage Special 3. It's also worth remembering with our Heritage product, there's some really good loan to values there. So Heritage Special 3 is up to 50.5% loan to value. We still have the cashback option available there. So with Heritage Special 3, you can apply for up to 5% cashback. So our cashbacks do really bump up those loans as well. So this example here is a male age 70 with a 15-year estimated term. The property value is 350,000. Taken out £140,000 loan. The loan to value is 40%, so quite a high loan to value there as well. So we've worked out that the minimum payment that they have to make to qualify this as an interest service mortgage would be £203.88, which is 25%. And the maximum that they would need to pay to service the whole amount of interest is £815.52. So as mentioned previously, as long as they are servicing within those amounts, so within 25 and 100, they could make £203, it could be £400. As long as it's in between those brackets, they qualify for this discount. As you can see there, so the 2 examples we've got, so full interest roll up with no monthly payments on the loan amount of 140. The amount they'll owe after 15 years will be 462,280, which makes the total cost of borrowing 322,280. And obviously no savings made there because it's just rolling up and adding to the total loan. With an interest service option, so 25% payment, so this is assuming the £203.88, and they're going to make these payments for 5 years. So monthly payment of 203, again, loan amount. So the total monthly payments that they'll make over that period, 12,233. And as you can see, a pretty big saving there of 42,000. So if they make 25% interest service payments for the 5-year period, it's £42,000 savings. So it's a really good, I think it's really good to actually show these to clients, to show the difference that it can actually make, even if it's 25%. So it's not even as if you have to do 100,000 to make 100% to have an impact on the estate, which I think is really well highlighted there. We have lots of resources available for you, lots of client scenarios. We have our marketing toolkit, which has been updated with some bits and bobs for this. So client scenarios, which really bring the product to life. There's a really good interest servicing calculator on our website as well. So as I mentioned earlier, you can put in how much they want to service. It could be a monetary amount. It could be, we want to service 30%. What does that look like? So you can kind of work with the clients and see what fits best for them based on your fact find. We have a YouTube playlist with some videos as well that you can watch, again, even additional CPD. And we do have some pre-recorded webinars as well. So if you need a refresher after this. when you're sitting with clients. What I would also say is make use of your BDM. So we've got obviously the BDMs in all areas. You've probably spoken to them already. But if you have any queries, or when you're sitting with clients and you're looking at criteria, or you're looking at how to quote this and things, just get in contact with either your telephone BDM or your field-based BDM, and we'd be more than happy to help. There is a QR code there which you can scan, which takes you to the interest servicing section on the website. It's all part of the heritage range, as I said. So there's documents on there as well with the heritage product itself, just as a refresher, but it's all really useful information on there for you to help. So that's the end of my slides. So Daniel, do you want to do questions now, or move on to your
we could jump through questions, and it just so has it that Alan's popped a question in the chat box
perfect.
below.
Oh,
so if you have a read through that, but thank you, Alan, for that question. And a reminder to anybody else on the call, please do have a think through and shout up with some questions. I can guarantee you won't be the only buddy thinking of those questions. It's obviously going to benefit you, everyone on the call, and potentially everybody that's watching this video retrospectively as well. But Alan's just asked a question for you, Gemma. How do missed payments work with the direct debit mandate? Hopefully no new mandate needs to be signed every time somebody says takes a payment holiday or something like that. Can it be managed online through the pure self-serve portal? And do the 3 missed payments have to be consecutive? Can they be, I don't know, month 2 of the year, month 5 of the year, and month 11 of the year? So a couple of bits to unpack there. Sorry.
Yeah. So they don't have to be consecutive. It's just as long as it's 3 within a calendar year. So they can be consecutive, but they don't have to be. It can be managed online. So on My Pure, there is a comment section in there where you can let us know questions. It use it as an email feature to let us know that they want to miss a payment. With the direct debit mandate, I'm not entirely sure about that one, so I'll have to check that. But as the direct debit set up in advance, I don't think they would, but I don't want to say definitely that they wouldn't. So I'll have to find that one out for you if that's okay.
It's definitely worth taking that one offline to probably the customer servicing team at Pure, who deal with this sort of payments on a day-to-day basis. Obviously, if if you're missing payments and you have a direct debit set up with any provider, your bank might well charge you for that. If you haven't got funds in the account to make a payment and they try and take a payment, there's things that might be out of the control. But you do absolutely right to ask that question, Alan, and we'll get that offline and we'll come back to you. I'll share the contact details if that's okay with you, and we'll go from that. Roy's just popped a question on. Roy's on the portal and he can't see the interest servicing calculator.
Yes,
I presume you're on the Pure portal, Roy.
Yeah, I don't think you actually need to be in the portal. Just let me find it for you. If you I'll find it on our website and I'll drop the link into the chat,
so you can have a little play with that. Graham's just popped a question into there as well. Is it definitely 3 missed payments per calendar year, i.e. could someone miss October, November, December, and then obviously the turn of the year, and then January, February, March?
Interesting. We did have that as a question on a webinar the other day. So in effect, they could potentially do 6 in a row in that way. But what I can do is as a result of a webinar we had last week, our products team wrote it out as an example. So I can send that to you as well, Dan, and you can send that out afterwards. With when the payments would need to be made, but yeah, it is calendar year, so in effect, yes, that can happen.
Yeah. I think the calendar year point there is crucial, as opposed to, I guess, the annual maturity of the loan taken out. So great question, Graham. We need to be thinking of these unique questions, because it helps Pure as well from the product perspective, right? This is a step in the right direction of product innovation, but there's always going to be things that we need to answer and amend and improve as we go through as well. Please do chuck some more questions in, but whilst we do, I will ask a question here. So this is one that came on the sign up. So people signing up had the opportunity to add a question when they registered for this event. For future events, please do take advantage of that, anybody signing up to future events. But will the discount interest rate apply after death or entry into long-term care? Essentially, if it's a joint life and there's those trigger points, will it continue, or are there trigger points where they lose the discount, i.e. first death or something like that?
No, so the interest rate will continue. on first death. So the person remaining in the property can keep the discount, or they can obviously switch it off at that point as well. So it won't trigger us to switch that off for them.
Yeah. Another one was, what is the treatment of the discount when it comes to additional lending? So that might be somebody that's taken a drawdown from a facility, or perhaps even a further advance additional lending. What happens there?
Yep. So any further advances, they can choose at that point whether to service interest on it. So they'll have the option to service the interest on their additional borrowing, and receive the interest rate discount if they want to make the payments. If they don't have to. So it could be that they have a lump sum, let's say of 100 grand, and then a drawdown of 30,000. They don't have to interest service that. So they could just have that as a section that rolls up itself. So it's choice at that point.
Yeah, if I remember back to when I worked for Pure, you treat the loans as separate loans, right? So a lump sum, drawdown, and any further advances, if they take them, they have their own account numbers, they have their own
Yes.
potential interest rate if rates go up or down as well.
Yes.
Steve's just asking here in the chat. So to be clear, if a customer wishes to overpay in the future, they will lose their rate discount.
They would need to switch their rate off first of all if they wanted to overpay without ERCs. So they can't do both at the same time. So whilst they're interest servicing, it's not ERC free. Once it's switched off, they can overpay as they normally would be able to.
Because obviously the client's receiving the benefit in a discounted rate and the
Yeah.
ability to pay for the interest. So it's the equivalent of, I guess, the same. Obviously, once they lose the discount, it goes to a standard overpayment facility, which I'm guessing is 10% on the heritage range, isn't it?
Yeah.
Can the interest payment on the drawdown be different than the original interest payment? I.e., say they opt to do, I'm guessing this is right, Tim, correct me if it's wrong, please. Say they opt to do 25% minimum payment on their lump sum. They come to take a drawdown, but they want to do more than 25%.
Yes, that's fine. So they can pick the percentage at that point. So it's applicable to that section. Perfect.
Thank you. I'm glad I didn't butcher that one, Tim. Thank you for that. And then we mentioned about monthly payments. It is just via direct debit, isn't it? There's no way,
Yes.
I guess standing order would be a little bit onerous on the client to set that up.
Yeah, so it's direct debit, and as you mentioned, set up at the start, and then the first of each month. It may be, as with mortgage contracts, the first payment is slightly higher, but you have that information as well. But we'd let the client know when the payment's going to be.
Good stuff. And then we've already nipped the other one that was asked in the sign up was, can they change the monthly amount after completion? But we've already established that if it's, say, the lump sum, then no,
Yeah.
unless they are losing the discount and going to a standard overpayment, which is as flexible as they come with obviously those products. I'm not seeing any more questions in the chat, but please do have a little think through. Just by way of I guess a virtual show of hands, if you could write the words yes into the chat box for me, depending on this question. Has anybody in the chat over the last year, 12 months, recommended, whether successfully or unsuccessfully, an ISM style product? Obviously there's a few different lenders now operating in this space, and some of them have been around for years and some of them are perhaps more recent over the last 12 months. But if you could pop yes or I guess no in the chat box, has anybody successfully or unsuccessfully recommended an ISM plan? Because I acknowledge and I also appreciate that typically the clients that we deal with don't have a ton of surplus income, right? So when it comes to making a judgment call on affordability and getting clients to commit to payments when they probably want to enjoy life a little bit and enjoy what is a traditional lifetime mortgage, that's great to see quite a lot of yeses in there. It would be great to understand the reason behind some of the perhaps no's. Maybe the more we educate and the more lenders that operate in this space, that will become more likely to be yes in the not too distant future. From the conversations I'm having with lenders across the sector, it's the belief that ISM style products will be a significant chunk of the market next year, right? So we're experiencing customers, and I'm going to guess you're all experiencing customers that are coming to you, inquiring for a lifetime mortgage, and perhaps a little bit disappointed to see an interest rate starting with a 5 or a 6 or a 7. And when you look at the base rate, we've had a reduction and a hold of that reduction, and the next review's in November. They're expecting mortgage rates for a lifetime mortgage. Obviously, they're a different investment model, short term and long term. And you're seeing 3 and 5 year traditional mortgages starting with a 3 now, which is great to see for traditional mortgage lenders. And it can be quite hard for customers to digest rates starting with a 5, 6, 7 and upwards. So ISM style products are a great way to bring that discount, to bring that lower interest rate, to make it more digestible for a customer, and obviously help them segue into later life. Maybe they're on a traditional mortgage, they move into some form of maybe a Rio or a Tio or something that requires some level of payment here, and then maybe they'll cap it off in years to come when it's more suitable with a Core ER with maybe without payment. But it's all around limiting the interest accrual, right? That's the whole point of these plans. And the whole point of the cost calculator, which I'm going to briefly show you in just a second. But I think that's it for questions. I've given you a few seconds opportunity there. If there is any more whilst we're going through this, or if there's any more questions for me when I'm going through the cost calculator, please do shout up. I'm going to share my screen now. Now I'm going to do, this is a live demonstration of the sourcing. So let's hope that technology plays with us here. So just bear with me. You should see if I could get a verbal yes to that. You should see my dog for a
While
second.
you're sharing that,
Awesome.
Dan, I've just shared in the chat the link to the calculator that we talked about.
Okay. Are you seeing my sourcing window here, advice-wise? Or are you seeing what are you seeing on screen?
No, it's not there.
Must have done something, not shared it. Hang on, bear with me. Screen one, share. You
There
should
we
be
are.
seeing advice-wise sourcing.
Yeah.
Yep. Okay. Follow through. If I'm quoting something that you're not seeing, because I brought up a new tab, for example, do you see the pure presentation I've just brought up in the middle of the screen?
Yes.
Yeah, okay. Just making sure we're all working technologically. Okay, so what I've done here is a product sourcing demonstration. Now I've done a very vanilla case here. Hopefully it's vanilla. I've done a 70-year-old single male. The property value is 500,000, and they are simply asking for a £100,000 loan. Firstly, what I want to achieve here is to show you how to request and source the ISM style products, and then link that to our cost calculator that we launched a couple of weeks ago. So I'll explain what our cost calculator is in a brief second. So very vanilla product. And for the purposes of doing a session with Pure Retirement, I have used our product filters and our lender filters to just show Pure Retirement products to keep it nice and simple here as well. And I'm just showing lump sum plans. If you unfilter them all, it can get quite complex. And I don't want to confuse anyone on this session. I've sorted this piece of research by cheapest rate, but by default, it will always sort to least cost to the estate. So total amount owed is least cost to the estate, and then you can obviously filter that by the cheapest just here. Now, the product I'm going to focus in on for the purposes of the cost calculator is the Heritage Super Interest Service. But before I go into the cost calculator, let me just show you how to request a KFI. And I know it seems really, really obvious, big get KFI button, but when it comes to interest servicing products across all the ISM lenders and the ability to choose what level of payment you want to make, there is another step on top of just requesting a KFI. So have a look at this one. This is the Heritage Super Interest Service. We know from the product presentation, and hopefully we've all took a screenshot of it, but we know from this slide that Gemma showed us earlier that the Heritage Super product comes with a 30 bip discount. So this is already discounted within the product research. So without ISM, if this was a core heritage product, this would be 5.8% MER, right? Okay, so if I click Get KFI, I know that I need to service 25% of the interest to qualify for this product. Click Get KFI, and you can put the monetary amount here. I'll just acknowledge the top part. I'm on a test dummy account, so I'm not connected with the Pure API. So just ignore the red warning at the top. But in order to input what level of payment you want to do, you can select 100% of the interest payment should you wish, or you can put in a monetary amount. Now it shows you the parameters here, okay? So it says the minimum, so essentially 25% of the interest, it's already calculated for you through the API, is calculated just there. If I put the bare minimum in, that will qualify me to be able to request this KFI. If I wanted to put £200 in, I could put £200 in, and you know the kind of the same theme goes on. You can go all the way up to £458.33. As soon as I go over that, it's going to tell me that it's exceeded the amount. Obviously, we don't want you accruing any ERCs, or you can't actually request a KFI unless it's within these parameters. So for example's sake, if I put 200, I'm on a dummy account, so the button for request won't work for me. But if I click request, it will immediately download that KFI for the pure heritage Super ISM. And then within section 5 of that KFI, it will outline the payment amount that I've put in as well. So it's not just going to default to the max on every KFI request. It is dynamic, and it does take your instruction as to how much you want to make payments on that. So that's really, really useful. If you are logging into your AdviceWise and you're getting these connect with lender accounts, it's essentially just to connect your API to the lender to allow you to do the auto KFIs and allow you to benefit from all of the automations that we have in place on sourcing. Now moving on to the cost calculator. The cost, we have a couple of different comparison tools within AdviceWise, and they help you help you towards a recommendation. They help inform you on the difference between certain products. And then more recently for the cost calculator, it helps you demonstrate to your client different scenarios of making payments. So it might be, I want to show a client what it looks like to make no payments compared to making just a £50 a month payment. That could be on a standard product. It doesn't just have to be on an ISM product. It might be, I want to demonstrate to my client what's the difference between making a 25% interest payment to a 100% interest payment. And then that will show you and illustrate to you in a graph format, in a table format, a printable format to help you bolster up your recommendations and help demonstrate price and value to making payments to your customers. So if I click the compare button, you'll see this at the top of every single product module. I can compare two products. And this is a comparison tool that's already been on AdviceWise for a couple of years now, but you can compare those products side by side. You can see the difference in rate, you can see the difference in fees, ERCs, features, and interest roll up. You can download that to your file if you want to as well. The most recent addition is the cost calculator, and you can see that highlighted at the bottom just here. I'll take one individual product for simplicity's sake, and I'm going to give you two ends of the spectrum, but I appreciate it's far more complex than this when you're diving into products. So if I take this product, if I click cost calculator, it's opened up a new window. You can quite easily go back to your research screen by clicking the X. But again, this is a tool to drive and build scenarios to then display to your client on the benefits of making payments. It's pulling in a live product, but you can also create blank products if you want. So perhaps your client's on a product that's a traditional mortgage that we might not have on AdviceWise. You can write the name, the interest rate, the loan. The calculations will all work the same in the background. It has got HPI calculated by default, but you can alter that figure if you want. If you're really optimistic and you think house price is going to inflate by 3% over the next year, then please put 3% in, or vice versa. And we have got indexes there linkable, so you can go and find out what's happening at the moment and what's likely to be. But it defaults by 2 because that's the average. So straight away you can see I've got this pure retirement interest only lifetime mortgage. It's the Heritage Super, and it's the 5.5% rate, which is already discounted. Without the discount, remember, it's the Heritage Super with a 30 bip discount. So without the discount, it's going to be 5.8. So I want to demonstrate here what would be the difference. So I'm renaming this just for my own sake of remembering in the future. But I want to show to the client what a 25% interest payment looks like. Okay. And then I want to duplicate this product module, and now I want to do 100% interest payment. Okay. Then I'm going to work my way through the calculator, and I'm going to work out, right, so 25% interest payment. We know from looking at that earlier screen the monetary amount. So if I put monthly payment amount, I think it was 114. It tells you the percentage here, by the way, to qualify, but you don't have to remember the monetary amount. You could tick percentage, you could put £25, 25%, and it will tell you the monetary amount equivalent of that percentage there as well. Okay, moving over to the second product that we're comparing, this is a 100% interest payment. So again, I can punch in 100% and it'll tell me the monetary amount. Or if you're talking to a client and they're saying, well, we can only really afford 300, you can absolutely put in 300 here as well, and it'll tell you the percentage, the equivalent, so that you can make sure that you're above the 25% minimum threshold and you make sure you're below the 100% minimum threshold for the purposes of ISM. For the benefit of all other products, you know, some of them don't have those parameters. Some things you might need to watch out for is ERCs. So a lot of the standard core equity release plans like Heritage has a 10% overpayment allowance. on the non-ISM products. So it's just making sure you're within those payment parameters there as well. But for the purposes of a demo, let's put 100% of the interest compared to just 25% of the interest. And again, this is just, I guess, £100,000 loan over a shorter term. Moving down, how long does this client want to make these payments for? So to term is using the ONS mortality tables and on life expectancy. But you can absolutely go over above and beyond and just say, well, hang on a minute. It's not realistic for my client to be making payments until they pass or go into long-term care. They only really want to make payments for the next 7 years because they've said this is a single life case, but if it was a joint life case, it might be, well, Mister's going to retire in 5 years, and it's expected by the time we get to 7 years, our disposable income's going to drop. And these are the sorts of conversations you're having around that. Okay, so you can determine it to a time period if you want to. And then we need to input, you do need to input it. It doesn't automatically do it at the moment, but we're aware of this. You do need to input the rate that it will default back to should you lose that discount. So 5.5, we know it's a 30 bip discount, we'll go 5.8, and we'll go 5.8 on that one. After every input, you'll notice these bottom tables aren't updating. You do need to click recalculate. So if I just click recalculate here, or if I scroll up and click recalculate here, it will then start to populate these tables. And I'm going to scroll down further to show you the graphs in just a second. And it's going to go through and give you a bit of information here. These are all printable, downloadable, add them to your file, share them with your client. So it shows you the loan at the term on product one, and then a comparison to product two, and it gives you the monetary difference there, the amount of money that you're potentially saving there, the amount you're paying over the term, and again, the amount you're paying over the term on this product, and the difference between the two options. Total cost, loan and payments added together, and then lastly, the equity remaining in the property. Remember, we've put the HPI reference at the top, so that will alter this too, and it compares. Scrolling down, it will show you in a cumulative table format, so you can see straight away that their payments are stopping after 7 years. It's going to go to a standard roll-up referenced on the non-discounted interest rate, and that goes down over the term to 15 years. That's the exact same with equity remaining. It will show you across these two products the impact to the property equity over the given term as well. And you can see how much equity is left in the property at term as well. Scrolling down, you can see the equity and loan and payments in graph format. So if I just scroll up here, put loan and payments, and it brings the different table here. So straight away, you can see the 100% interest payment, that loan amount is staying the same. But remember, after 7 years, turned it off, after 7 years, that's going to then start to accrue interest again. So then that starts to go up. Okay, just a 25% interest payment will keep that nice and steady over the term. And then that graph illustrates the value that the client still holds in the property over term as well. So that's quite nice to do. And again, I mentioned you can take things off, you can add things on. If you really want to, you can add lots of different comparisons here. You can duplicate this, you can add the more blank products, and then before you know it, you've got a table with quite a few things populated. So you can go through with a client with this on a laptop on the table, or you could print it off and display that to a client as well. So if I just get rid of these last couple for example's sake, if I then recalculate and download this PDF, you can see what that printout looks like that you potentially will be sharing with your customer. So I'll zoom in a little bit here. It's just like a piece of research, but this time it's simply a comparison of costings, a comparison to show and display the impact of making payments. So you've got your two products with your product inputs. There is a warning at the top. Currently this calculator doesn't factor in any ERCs. So if you're going over a payment amount that triggers an ERC, we've not factored that in yet. However, we have referenced it at the top to make sure all the advisors using it are well aware of that. I'm working on it. I'm well aware of it, and we'll try and get that sorted as soon as possible. Loan and payments table for the two product comparisons are just here. The graph for the loan and payments, and then the table for the equity table, graph for the equity over time as well. It's fairly simple tool in all rights, but it does have quite powerful capability of demonstrating making overpayments. And again, to highlight, this isn't just for the benefit of ISM, it's for all products with an overpayment facility. to help clients understand that making payments will mitigate the roll-up of interest and essentially help them keep value in their estate over time. But again, I acknowledge there are lots of clients that just don't have the disposable income to be able to support these payments. So it's as and when it fits, as and when it's appropriate. So I hope that helps better understand it. I'd encourage you to have a play around with it yourself. I'd encourage you, if you haven't already, book a demo with myself or the team to better understand how to use it for maybe your next client, and we can run through it with you, and we'll go from there. Graham, I've got a question there for you. Let me try and understand. I might have to bit this one offline. Do you or can you specify how many years you want to make payments during the KFI request? On the cost calculator, you can. Hopefully that was clear. I can specify that I only want this to happen for 7 years. From a pure Heritage ISM KFI request, you don't specify up front when you're going to stop payments. You would probably get to it and then update the team, right? Then you'd lose your discount at that point. Or can you line that up from advice?
Our illustration works on a 1/3 payment rule, so it assumes that the customer's paying it for 1/3 of the term. So if it's 15 years, it will illustrate the amounts paid for 5. So it won't show that because it's not specified at the front. It just gives an example there. But obviously the calculators and the cost calculator will show that for you as well.
Yeah. Okay.
Does that answer that question? I think
that makes total sense. Absolutely. And I think most of the lenders now have amazing customer servicing teams where you can ring up and ask these questions on the fly should you already be in contract. But yeah, it's great to keep asking these questions if we're unsure. We'll get you some more details too. Any more questions? Any more from the chat? Anybody want to unmute and not be shy and ask some questions? You're more than welcome. But hopefully we've covered a bit of ground there, and we've given you some homework to go and have a play around and have a little find out what works for you and what works for your clients. Any more questions? I'll take that as a no then. But okay, we'll look to round up. Gemma, do you have any questions for the audience? I guess how they're finding the market at the moment?
I would just reiterate: make contact with your BDM. Have a look at the tools on our website as well. Especially the toolkit options with the case studies, because they're there to help you, and we can white label as we usually can as well. So I've put a link into the interest service page on the chat there. But any questions, let us know.
Great stuff. Well, just to wrap up then the session, I'd just like to take an opportunity to thank Gemma for taking the time to do the session with us today and taking the time to do the session with you guys all today as well. Thank you all, delegates, for joining us this morning to run through this. I have put some links in there. Lastly, just to go through any future events that we're doing. So if you wanted to join more webinars like this, if you want to have a look at what's happening in a sector, there's quite a few good events, not just hosted by AdviseWise. There's an Aviva event that I would plug there for Valuations Unlocked. I would encourage you to get onto that. And that's tomorrow at 10 o'clock if you have the time. And there's quite a few live events coming up as well, including the Equity Release Council Later Life Lending event in November. Hopefully we'll see you all there as well. Again, to reiterate, this session has been recorded. You will get a follow-up email with the link with some of the resources and signposts to the pure retirement items that we've discussed through today, and naturally your CPD request link will be in there too. Again, book a demo if you haven't, but if that's all from everybody, no more questions, we'll wrap up. Have a great day. You are free to leave, and thanks again.